The Hedgeless Horseman here. It's April the 30th, 2023. I'll try to make this video actually short. I know I say that a lot, but I'll try. And I'm going to talk about individual cases and how risk-reward is, typically the higher the potential reward, the higher the risk and all of that. And also the reason why when people ask me, is this stock a buy, or what stock should I buy, or etc., etc. It's like every single case is unique. And you have to understand why it's unique, or what the risk reward is. As far as you can tell, nobody knows the exact risk of any stock. Nobody knows exactly what any company will do. Nobody knows anything really about the future. We can just make educated guesses. And obviously, if I knew that a stock would go up exactly X amount, with no chance of something going wrong, let's say, I mean, I would be all in the stock that I knew was going to go up the most. I have no idea what stock is going to go up the most. And because I got a question here, which will do better, by Mark Much, and he listed a bunch of stocks. Like, I sure can't say what stock will do best. But that's of course, like, that's what everybody kind of wants to hear. Just tell me what stock will go up the most and I'll buy that. Basically, here, give it to me on a silver platter. I don't want to do any work. I don't want to think about stuff. I don't want to, yeah. Just give me the one that will go up the most. And of course, funny part is that, again, even the best success stories have big corrections. So it's also, there's no time frame in this. There's no, like, I can only take this amount of risk or anything like that. So it's impossible to answer. With that said, we can say a few things about each case and how, the risk reward probably differs. And that's why it's like when I write my, let's say, an article on a case, I don't say buy this. Let's say, buy this because it's going to go up 100% or whatever. I try to outline what I see are the risks, why it should perhaps go up, kind of a sense of maybe the ballpark of different upside scenarios, how much it could go up, etc. Stuff like that, so people can form their own opinion. Because if you understand what you kind of want to see happen, or you understand the risks, it will make it a lot easier to come up with a better or an appropriate position size, and have some, let's say, be calm about the volatility of the market. Because if you say, hey, I think this case is going to do well over 2 years, assuming this and that and this and that is going to play out, you understand that, I probably need to hold this for maybe a year or two for this to potentially play out. Because again, it's like which will do better. Some of these are more riskier than others. Some have less upside potential than others, but are less risky. Take a Newfound Gold, for example. Tier 1 jurisdiction already has a discovery. I mean, they probably have a few million ounces at least. And I have no doubt, like I wrote here, that Newfound Gold will continue to hit, not in every hole, but will continue to hit, real headline holes. Newfound Gold will grow from where it is at now, regardless if it's overvalued or undervalued relative what they already have hit, let's say. Yes, I think newfound gold is going to grow because they have so many targets. They're making new discoveries. The Appleton Fault Zone, for example, they control 70 kilometers of strike, etc. If I had to guess, yes, I think newfound gold will be worth more 12 months from now than it is today, and 24 months than it even more 24 months relative to 12 months, etc. It's also the highest valued one. So which means that it's going to be harder for newfound gold to go up 3 times, for example, in a sense, than a company like Inflection Resources, which has a market cap of like 24 million. Newfound gold is already pricing in that there's a pretty good shot that they have a mine already. Not a Fosterville type mine, which is, the why I think there's still room to the upside. But at, 700-800 million market cap, some kind of economic mine is priced in. I would say that there's less risk in newfound gold relative to most. I mean, Inflection Resources has not hit a discovery hole yet. So we have no idea, when all is said and done, assuming Inflection Resources, they get the deal done with Anglo Gold, they drill 5 targets or whatever. They might have anywhere from 0 to 5 or more discoveries, since they have like 23 targets or something. If a company with that small of a market cap makes a significant gold copper porphyry discovery in New South Wales, obviously that could become a 10, 20, 30 bagger potentially. So you have more upside potential in stories like Inflection Resources, huge targets, low market cap. Well, they're after huge targets. Brixton, which is partnered with BHP. BHP, we know, is looking for the biggest possible targets around of any miner. Obvious high upside potential. Which is BCM, also looking for big. They're drilling a big porphyry target, but they kind of have, I think, only the one target. So there's a future where BCM has made a discovery hole, and in a year or two maybe we'll know that, hey, this is a really nice big porphyry deposit in, I think they're in Arizona, or somewhere in the US, so like tier 1 jurisdiction. Given the market cap of BCM, which I think is around, 15-20 million, there's obvious some enormous upside potential there. But maybe the chance of finding such a deposit is 20%. So it should be, let's say, price in a 20% chance of finding something worth, 500 million, a billion. We don't know even what the size is. I mean, it could be a huge one. It could be a big one. It could be etc. etc. Because there's a lot of porphyry deposits, but there's only one Escondida porphyry deposit, for example. It's like, yes, Philo Mining has a market cap of around 3 billion. There's a lot of other porphyry deposits out there which are known and have been discovered, and they might be trading at 50 million. So it's not just, yes, you found kind of what you're looking for in a sense. It's also like, what's the magnitude of what you found? Some porphyry deposits might be worthless. Some might be worth a lot. Some might be a KUYA or a Philo Mining type situation where they're worth billions, potentially. I mean, we know KUYA is worth billions because they're actually mining, but we don't know when Philo Mining will be mining Filo del Sol or whatever it's called. So there's a huge amount of unknowns at all times. Typically I try to correlate the risk aspect with the position sizing. The higher the risk, the lower the position size. Because if you, let's say, went all in the less risky one here, or least risky, maybe that's, let's say, Dolly Warden, LIO, or NFG. Dolly Warden has, multi-million ounce deposit, regardless if you count this silver equivalent or gold equivalent. That's probably not going to get worthless anytime soon, and we already know they have a bunch of gold and silver. Same with Leo. Well, they have a, let's say I think they will have a payout soon. I think they will have both a payout and a resource. So let's say they at least have 1 million ounces of high-grade gold. That is, in one sense, more risk because they're actually going towards mining. I mean, Dolly Warden and Newfound Gold, if they become mines in 5 years, there's no risk of them going, let's say they take on debt. There's no risk of them going bankrupt anytime soon because they don't have debt. And it's very hard to go bankrupt if they don't take on debt. And there's no way for the gold and silver really to disappear, which they've already found. But of course, LIO, if they actually, if they go now, because they're soon expected to be in production, or relatively soon. I mean, they're working fast towards towards production. If they make that work, I think the current market cap is going to look very cheap, and then they have at least 1 million ounces and could have a multi-million ounce system. So they could theoretically go the way that, let's say, K92 did. Started off with small production, grew and grew and grew, and all of a sudden you have like a 10-15 bagger 3 years later. That is not something most companies can, let's say. I mean, that's why I keep talking. It's like there's a higher chance that you get a 10 bagger after a discovery than before. Newfound Gold IPO'd with one hole at $1 per share, $1.10, $1.20. That ran up to what, $7-8 after the discovery. Now it's down to like $7, I think. Still a multi-bagger after the discovery. It's much more likely to grow after a discovery hole, obviously. Well, since they knew, okay, we can hit 19 meters of 60 grand per tons or whatever the discovery hole was. What happened later? 2-3 years later, they've hit a bunch of really good holes. So the first discovery hole was the start. It was like SK Mining, for example. Do they have a mineable deposit already? No, I wouldn't say so. Does it have a lot of potential? Of course, since they have a huge land package in this SK Creek district with more targets than they can even drill in any given season so far. If they hit, I expect them to test some of the geophysical targets which have been outlined recently by that consulting firm or expert geophysicist firm. Do I know SK is going to hit an SK Creek type hole, which will make the market pay attention? Because now, in this current sentiment, you need something typically spectacular for a exploration story to revalue higher. You've seen, I don't know how many hits. Juniors growing their deposit, let's say making some kind of discovery. Market doesn't care. So it's like, which will do better, etc. I mean, it totally depends on the sentiment as well. It's like, if you said which will do best in 12 months, not only does it depend on what the companies do, what the results will be exactly, which we don't know. We also don't know what the sentiment is going to be over the next 12 months. If we knew that sentiment was going to be red hot in 12 months or within 12 months. Like, went from a 2015-16 bear sentiment market to 2016, the best rally ever in miners. Everything here on this list will go up. If sentiment for some reason got even worse than it is today, we don't even know that the ones who actually have a technical success will actually go up. We don't even know what's required in terms of technical success for the stock to, let's say, break through the sector sentiment and actually get rewarded. So there's just a bunch of unknowns. I never know when. I never know exactly what's going to happen to a single stock. I just try to we know that the big sentiment changes for the better, not for the worse. So that's why I'm in the sector. I don't know when that's going to happen, but that's enough to, keep myself playing, let's say. But it's like we have Valora Resources, for example. Yeah, I should have mentioned them as well, obviously. They're going to have a resource out soon. I think it's going to be a big one. So we will know that, yes, Eloro for sure has something worth mining. It has value. That's not going away, regardless of what sentiment does, regardless of what silver, gold, and whatever does. I think it will show that they have a huge metal endowment. How will that be received by the market? I don't know. Depends on the sentiment. Depends on what the exact numbers are, etc., etc. But I would have a higher weighting in a store like Newfound Gold, Lio, Dolly Warden, and Elo, which we kind of know. We know have something worth mining, pretty much, or probably worth mining. They have significant resources already, compared to pretty much every other stock here. So I see them as less. I can't. It's hard to picture a future where it's like what Newfound Gold is hit, where that is actually worthless, where Dolly Warden's deposits are worthless, where Lio's deposit is worthless. But like we've seen with pure gold mining, if the mining goes south, there's still 2 million ounces that pure gold mining has, but they added on a huge, pretty large amount of debt. They didn't get the production to work, so that went to zero. Gold didn't go anywhere, but the rubber hit the road, and they were, I guess, undercapitalized, and their mistakes were made, etc., etc. Lio has very good mine builders working for them, like Patrick Hickey. So if you want to go into that situation where you build a mine, you obviously prefer the best ones to be building the mines, like Irving. We know they've hit gold on pretty much every target they've drilled. We know there's a lot of gold in Japan. What will they found beneath the buried sinter? I don't know. What will they found at depth at Nanko? I don't know. If Yamagano gets drilled in around late this year, will they hit something good? I don't know. I don't think it's expensive relative to the potential. It's like Novo. Given the amount of targets, etc., are they going to hit a Hemi? I don't know. Timberline. We know they have gold there, etc. And they are going to be drilling the CRD targets that are close to I-80. Do we know what that's going to hit? Nope. We don't know. FFOX. They have a discovery at Mustajärvi. That looks pretty good. Do we know how big that is? Nope. Is it cheap? Yeah, I would actually say, FFOX is cheap. The share structure is not ideal, obviously. But yes, it's like, I guess my point is that nobody can answer which will do better. And that's not really our job, because it's a fool's errand to try to know what will do better typically, because nobody knows exactly what anything will do. It's like Brixton. If they put out if they find a high grade core to the porphyry system. If that happens, Brixton will probably do very well, assuming that it can show it has size as well, because it's so cheap. So there's obvious upside potential. But what is the chance of success we would require? I don't know. Maybe that's only 10% chance of success. Maybe it's cheap, etc. But still, you wouldn't go all in with 10% chance of success. But they have the Trapper gold target as well, so that's got to be factored in. What are the odds that Brixton becomes worthless? I mean, the Trapper gold target looks like that should grow. I would say their Camp Creek is more a swing for the fences. They know they've hit. They're probably going to hit some more. But does it have BHP type size? That we don't know. KUYA. Will they get Bethania to work? Who knows? They've hit very good holes up in the Cobalt camp with insanely high grade silver. Is that a limited thing, or is that gonna grow? I don't know. But every single stock here has potential, obvious potential. The potential vary, and the risks vary. It's like bam. From a risk-reward perspective, it's like, what are the odds that it becomes worthless, and if it, permanent loss? What are the odds that it increases in value and makes this market cap look cheap? And what's the ultimate blue sky? What's the ultimate runway? I think VAM has a really good risk-reward, because they have potentially a whole CRD district. They only drilled off I don't know how many meters, 400 or 500 meters. These systems can be very large, so there could be a lot more to find, and in that case that would look cheap. What are the odds that they don't hit anything more? I think those are pretty low. It's like if they hit at the last hurrah target, for example, which is I think 2-3 times as large according to the physics than what they hit so far. Obviously that would be material, and they could prove that perhaps in this coming season. Goliath, they will be drilling more, and I expect them to hit more. Will they reach something worth mining? I think there's a fair shot of that. What's the current market cap? I don't know, 70 million. That's not pricing in a mine, obviously. So it's I think all of these have obvious upside potential, but I don't know exactly which one of them that will end up with in a blue sky scenario, because and that's why I own them all. Newfound Gold upside potential, it's I think it's quite low risk, still upside potential. Maybe you could get a double or a triple within 2 years with relatively low risk. I think that's great risk reward. SK, more of a high risk, high reward one. If they snag some, we know what SK Creek was worth. If they hit something, and SK Creek wasn't even big, but if they make a discovery, etc., this season, I think their current market cap is gonna look very cheap. So it's maybe 2-3 bagger potential, quite low risk, 10 plus bagger potential with real risk at least. Lio, real risk since they're going into mining, but could be if they did K92 and gold price is favorable. I mean, I think there's 10 bagger potential. Dolly Warden, quite low risk, I would say. But they're gonna drill a lot, so it's this could still be a multi-bagger with quite low risk, I would say. ELO, I think it's very cheap. It's problem with sentiment of Bolivia more than anything else, I would say. If they hit the tin porphyry, I mean, it's just gonna look crazy cheap from an economic standpoint. And they have a big deposit. Well, we'll soon find out, but I think it's pretty clear they have a very big deposit. Goliath, obvious multi-bagger potential, I would say. They're going to be drilling as well. So it's like, again, and of course the thing is, which I touched on when I responded to Bonzo here, because I had written that I took a punt in Dynasty Gold. What tipped me over the edge was that Rob McEwen was taking a position in the financing. And like he says, Rob McEwen made me a lot of money at GG, which I assume is Gold Corp. I'm not 100% sure, actually. But he was the kind of the founder, I think, of Gold Corp, and that he took that to the largest gold miner in the world at some point. So, I mean, if you followed Rob McEwen early in Gold Corp, you probably made a huge amount of money. McEwen Mining has not done very well, and Pure Gold Mining went to zero. However, he was also early in Great Bear, and that from where he got in, I don't know exactly how much that went up, but it's like from when he got into the final sale to Kinross, I'm just assuming it's at least a 20 bagger. So my point is that I mean, like Bonzo here highlights, like he made me a lot of money in this one, but I followed him into my sorrow. So I guess what he's saying is like, yeah, but he doesn't have 100% hit rate, so it's like you never know, let's say. But when you think about it, how skewed, I mean, you only lose 100% when you lose. So it's like if you were in, like touch on here, if you invested with the same amount in all of these 4 stories, I'm assuming again this is Gold Corp, but I'm not 100% sure. It's like you took let's say a 2% position in Great Bear, 2% position in Gold Corp, 2% position in McEwen Mining, and 2% position in Pure Gold Mining. This would, one second here. Okay, yeah. So you let's say these went to zero, even though McEwen Mining has not gone to zero. But these would be minus 4% to your portfolio. I don't know what Great Bear, that would be a, let's say a 20 baggers lead, so 2% 20 times. You would be up to your this position would be 40% of your portfolio if you rode Great Bear to the end, let's say. So that's like 40%, or let's say you added 38% to your portfolio from one stock here, if you rode it till the end with full position. Obviously that's not what people typically do. And I've talked about this before as well. That's like people take money off the table, typically a lot of money off the table, if they're in early in a story and it goes up 100%. They take half off the table. That would be almost like cutting this in half instead. It has drastic implications, obviously. But from a hodl perspective, let's say, Great Bear, if that went to 40, it would have paid for almost 20 similar sized positions that went to zero. I mean, that's not 100% correct, but you get the idea. Let's say you got a 10 bagger in Gold Corp here, so that's 2 times 10, 20. So theoretically, Great Bear and Gold Corp alone would make up 60% of your position, and you started with 4%, so it would have added 56%, starting from just 2% positions. They would make up, or they would have added 56%. You could have a lot of losers in that case. 56%. I mean, that's, yeah, 56 times divided by 2. 28 other bets of similar size that went to 0. 28. And you would still be neutral. That's why it's like when I see people lambast other people for like, yeah, you bought this stock and it went bad. Like, how high do you think the hit rate needs to be? I mean, if we're talking, 10-bagger potential, let's say. I mean, if those materializes and you actually take, let's say, full advantage of them, you don't, take out 80% of your position as soon as it is up 150%. They're gonna pay for a lot of losers, and I'm not saying mistakes because you only see the results. I mean, was it a mistake to follow Rob into Max or Pure Gold, McCune Mining or Pure Gold? I don't know. We just saw what the results were. We just saw the negative scenarios that happened. What if Pure Gold worked? What if they, gold price at the time, whatever. It's like, COVID happens and cost inflation, whatever. Excuse me. We don't know the future. But the winners are supposed to take care of a lot of losers. And I've had a lot of losers. Like I talked about before. I was greedy enough to be all in Novo going into bulk samples and saw my entire portfolio and pretty much my whole net worth go down 30% in one day. Yet, years later, that same portfolio is up thousands of percent. Why? Because you have some winners along the way as well. So, and again, everybody dreams of, let's say, which will do best. So if you think that, if I say like, I think whatever stock will do best, and you go all in that one and that doesn't happen, well, that sucks. But if you had a portfolio of all these, given where we are in the sentiment cycle, all of these are not going to go bankrupt, I don't think, before this turns higher. So, and that's what I said before. Right now, given where we are, we know when the tide comes in, the ones that are, let's say, around, they're still around, they'll go up. That's just how this sector works. So when you're down here, you don't want to take too big of a risk. You don't want to be all in something. Let's say, sure, it's mostly copper gold, but let's say you were all in on, where is it? Inflection Resources. Yeah, if that works, if they make a discovery, prove they have at least one significant gold copper discovery, your portfolio could 10-bag. If that doesn't end up being the case, you'll probably lose money, at least 50%. I mean, it's going to be hard to kill the entire portfolio anytime soon because they have so many targets, but you get the idea. That wouldn't be too great, given that, okay, the low-hanging fruit is to just be in the sector and survive until the whole sector goes up. That's why it's like I'm quite diversified. I have, I don't know how many. Some positions are larger than others. It might be because you get a good financing deal. It might be because the case is so superior, or the risk reward. Because I mean, for example, Magna Mining is a very large position of mine, simply because I think it has good probable upside, high potential upside. But I also see there being a low risk that what they have will become worthless. I think they already have something worth mining, and given how advanced it is, that could get mined, and given the team involved, I think there's a good chance of it successfully being mined. So the question is that when you think about risk reward, for example, high risk, high reward stories, if they make it work, they can go up a lot more than the more advanced newfound gold plays. Let's say, I mean, the ones in exploration stage still. Well, kind of pre-discovery stage, I guess. Like, I wouldn't say Brixton is actually not a pre-discovery, but let's say BCM and inflection. If they hit, they could go up a lot more than a newfound gold can in the next 1 to 2 years. But there's also a significant risk of them not making a discovery, and if they even make a discovery, that it does not turn out to be a significant discovery, etc. Dolly Warden and newfound gold and like Eluro, there's a low probability of them becoming worthless, because I think what they already have, at least for Dolly and Eluro, I think price is here and what they already have is kind of here, and they still have upside potential from here. So it's like, you know, what matters the most is long-term absolute returns. If you went all in a high risk story, it turned out well, you go up, I don't know, 400%. And you're thinking, whoa, my God, 400%. If I keep this up, I'm going to be multimillionaire in no time. Problem is, that's going to teach you to take enormous risk. And let's say the actual chance of success of those working out is like 20% max. So you get lucky with one. You take huge amount of exposure, huge amount of risk. You get lucky, so the 2% chance of success happens, and you make, 300-400% or whatever. And like I talked about before, even after discovery, even though that's why pre-discovery plays typically are not worth it, because you take too much risk for too little reward. Because if you get into a pre-discovery story, they make a discovery hole, the stock goes up 100%. And everyone else can buy in 100% at a 100% higher price, but they didn't take the discovery hole risk. So now the target is much more the risk, they only pay up 100%. Whereas you got 100% return, but maybe you took 80% chance of failure risk. You need more. Let's say, there's an 80% chance that it goes down 50%, 20% chance that it goes up 100% before anybody else can react and actually buy in. That's not great risk reward. But people think that, Great Bear, there's like, let's say this was the discovery hole here in Great Bear, and this is when other people could buy in. People think that you need to be in at the bottom. Okay, yeah, you get a 600. Obviously we know Great Bear ended up doing better, but let's say you take a lot of risk for a shot of getting 100% return before it turns into 657% return. But other people taking a lot less risk could still get a 558% return. The risk reward in paying when you pay up 100% for a much higher chance of future reward, it's just superior. And that's why I wrote in the checklist, keep it simple. It's like no pre-discovery plays, because for some reason it's like, and I get affected by this still. Our greed makes us think that to make a lot of money, we need to be in at the absolute bottom in everything. But if you bought this, take newfound gold for example. If you thought it was, hey, I think newfound gold has, a good shot of at least creating enough value that the share price should go up 20% over the next 12 months, and people are like, boring, snore. etc. But if you compound, if you started with your portfolio with $10,000, compounded for 20% per year, which doesn't sound a lot. For 20 years, you deposited $200, and you just looked for the slow and steady, the probable growers, the ones that are typically perhaps more higher value than the high risk, high reward plays. I mean, in 20 years, that $10,000 plus deposits ends up being $955,000. But everyone, almost everyone, is looking for this kind of return, within the next year. So they end up piling everything they have into cryptos and high risk, high reward plays, etc. Whereas they basically take on too much risk, because let's say crypto is the best example. I knew a lot of people who went into crypto during the crypto phase, and when they have the initial coin offerings. I remember one guy, a smart guy as well. He was making a lot of money. His friends were making a lot of money. They were suggesting basically that you can't lose. Every single initial coin offering, which is basically an IPO, they all went up like hundreds of percent as soon as the coins listed. So it was like printing money. Then suddenly the music stopped, and most of them lost all the money they had made. Why? Because they, for a time, got so enormously rewarded, and the game looked so easy that obviously if you put in $10,000, you turned it quickly to $100,000 just from initial coin offerings. You obviously are gonna start to think, hey, if I can take this 10,000 to 100,000, I can take in the next initial coin offerings, I can take that to 1 million, and then they start to think about, hey, I'm gonna be a multimillionaire at this pace. Maybe I'm gonna be a billionaire. So they keep taking that huge amount of risks. And when the music stopped, most of the coins probably went down 90%. So that's the thing. I'm not worried about the get rich quick people, from a jealousy standpoint. Because sure, if you went all in on Dogecoin, had a 10 bag or whatever, with all your money, how are you going to replicate that? The crypto bubble is probably the biggest bubble the world has ever seen in the financial markets. That's probably not going to come anytime soon again. You have no tools how to make it over the long term. But if you did the work, did sound investing, was able to average 20% per year, and deposited a bit more money that also compounded at 20%, you will get rich eventually. If you take this to 30 years, it would be $6 million. If you put in more and more time and effort, so we cut that to 20 years, but you did a lot of studying, a lot of investing theory, brainwashed yourself with like Warren Buffett stuff, yada yada yada. You started to appreciate how much you can make just from going from here to here in this cycle. So you know that you should be, have high exposure long here, less here, whatever. So you learn a few things. Stop betting big on pre-discovery plays and all of that, and you increase your interest rate to 25. So instead of what was it, 955,000 over 20 years, all of a sudden it's 1,919,000. Getting rich slowly is really the only proven reliable way to get rich. But everybody's aiming for 100% returns within every month, let's say. So let's say pretend this is months. So in a year you start from 100%. Within 12 months, a year, you expect to have 56 million. That's what the people in crypto did. And now when that music is over, they have no way, they don't even know how to, they have no strategy. It was a one-off, they got lucky, took too much risk, got lucky. If they got out, most people obviously ended up losing money in crypto, even if they were up thousands of percent at one point in time. Investing is a marathon. Your job is to have the best possible portfolio returns over the rest of your life. 20% is a return that very few people can manage to have per year. My point is that this is more than good enough. You don't need to take enormous risk and try to have your portfolio go up leaps and bounds. It's not needed, especially when we're here, because this alone, which is inevitable, that the sentiment is going to go from worse to better, that's in the bag. We know that's going to happen already. That's not a gamble, that's a certainty. I don't know much better risk reward than certainties. So why on earth would you risk a certainty by gambling? Let's say you take on leverage that you need this sector to turn around anytime soon, otherwise you're gonna have a margin call, or you can't, suffer this going back down here again or whatever. Because then you're risking the only certain thing you have in this sector, that sentiment always changes. That's why I'm quite diversified right now. More than most times, because I want to make sure I'm exposed and I'm still in the game when this happens. Up here, if you're very diversified here, you're gonna make sure that you get the full brunt of the mean reversion down. Here I want to be sure I get the full brunt of the mean reversion higher. It's a silly easy game, but that's markets, and if you only grasp that, again, it's like you can play Pong and beat the market. If you understand Pong and what a good risk reward is, etc., you can beat this market forever. If you just get this point. The markets go up and down, up and down. Sentiment always changes, always changes. When you're down here, you want to make sure you're on the long side so you get exposure to the inevitable move here. Up here, well, it's a bit harder. It doesn't say that it can't go up higher, but like I've said before, okay, this wasn't the top, obviously. It went higher. Okay, this wasn't the top either. It went higher. The only thing we know is that no uptrend lasts forever. The longer an uptrend passes or persists, every single tick, this is a weekly chart, every single candle it went higher. Every single week took it 1 week closer to the inevitable downtrend. Every single tick higher meant that the fall is going to be even higher. Worst possible day of buying was on the last week of the uptrend from the highest possible price. The worst time of selling is when the last week of the downtrend, which is inevitable to stop. Well, it's inevitable that it will turn into an uptrend. So we know that again, it's like if you sold here, that's bad. Selling here is even worse because that's 1 week closer to the next uptrend and from a lower starting point. This might have been the bottom. I think this was the bottom. But all I know is that we're not close to some kind of high sentiment environment yet. So that's why I'm fully invested on the long side. And I still think beta makes a lot of sense, meaning the proven stuff. Because an ounce in the ground can trade maybe at $10 per ounce here. Here, up here, it might trade for $80 per share, per ounce. But still, going all in on shitcoins, just because you want the absolute highest beta. So you're only in crap companies, crap projects, have a very, very hard time raising money. If this downtrend or sentiment low persists for another 6 months, maybe these shitcoins who for good reason have a hard time raising money, maybe they will dilute down the stock by 30%. That's 30% less upside before the inevitable climb higher. You'll probably end up making money, but there's also a risk of actual bankruptcy. So it's like, what are the risks of bankruptcies here? Newfound Gold is probably not going to go bankrupt. They have no debt. They have a great project. SK have no debt. They have great potential at least. And I think they will have a more limited program this year, but that's fine with me. It's cheap, and obviously since it's cheaper, that means that one discovery will have a higher impact. Lion 1, that actually has a chance of going bankrupt theoretically because they have taken on debt. But if it works, it will pay off even more because it's leverage and they're going actually into production, etc. Dolly Warden, no risk of going bankrupt, have a lot of money, backing from Hekla, a lot of success. Elora Resources, no debt. Goliath, no debt. Inflection, no debt. Some money, probably backed by Anglo Gold soon, which will pay for the whole exploration efforts really, or for at least I think like $8-10 million. So if that happens, we're very, very far from going bankrupt at least, even although they are the ones who actually don't have a discovery yet. Irving at like 10-12 million in the bank, backed by Sumitomo and Newmont. No chance of going bankrupt anytime soon. Novo has fixed costs, etc. So I guess that's a bit more risky because they have cash burn. Forced cash burn more than the typical junior, but they're also cheap and have a bunch of targets. So again, it's like you don't go all in on any one of these. I'm not going all in on any one of these, because if you did that, you take huge project and company risk, and you risk not being a part for this inevitable upturn. Makes total sense. It's like Timberline, we know they have gold. Nevada, no debt, no risk of going bankrupt. FFOX, no debt. Brixton, no debt, backed by BHP. BCM, I don't think they have any debt. Huge project risk though, because that's like they have one flagship target. If that doesn't work, if they don't end up finding something, you don't really have much to join this ride later on. KUYA, I don't think they have that. Diversified with 2, let's say, flagship projects now after the discovery in Canada, so that's nice. VAM, no debt, great looking project, tier 1 jurisdiction, etc. Well, this ended up not being a short video at all, but it's just hard to make it short because there's so many facets to everything. But I hope I made my point clear. It's like it's impossible for me to answer which will do better because I don't know what's exactly going to happen in the future. I just know that any one of these have like 3 to 5 to 10 bagger potential. And like in Bonzo's case here, it's like you don't need to have 50% hit rate. If you buy it cheap enough, when the upside potential, assuming things go well, is large enough, it's gonna pay. I mean, that's the thing. It's like if you bought the same juniors here, back here, the upside potential might be 1/3 of what it is, or less than that, than what it is right here. So maybe you would need, I don't know how much, you know, the hit rate, you know, that any of the companies actually turn up finding something close to blue sky. You might need 40% hit rate, something. Down here, you might need 15% hit rate. Because obviously, if company X is looking for something that could be worth 1 billion, let's say, 10 companies, they all are looking for something worth a billion. If back here, all of them are valued at 500 million. That's like, if blue sky happens, you'll double your money. Price to value gap, sure, I mean, they might actually go to 2 billion because markets are markets, etc. But that's not a great risk reward. You would need, and assuming the other ones went to 0, you would need 50% hit rate. Let's say the juniors are now valued at 50 million. And they still have a 1 billion target price. That's 20-fold. 20 times upside potential. Here it was a double. So you wouldn't need, I mean, when you think about it, you would only need 5% of the companies to go up, you know, for blue sky to materialize, to be even. 50% hit rate needed, 5% hit rate needed. Huge and absolutely enormous difference. Absolutely enormous difference. I hope you get the points. Like, the only thing we can control is what price we're paying. I have no idea what any of these companies will exactly do, at least the share price. But I think some are riskier than others, and the ones that are riskier than others have higher upside potential typically. And also remind myself that, like, if you can just average 20% per year, you're gonna kill everyone else, basically. Because nobody's playing that game. That is too boring for people. If you just invested in companies which you think are likely to double every 2 years, that's like, I think that's around 42% annual compound rate. If you only invested in companies where you think, hey, over a 2-year period they're gonna double, I mean, you can't sell that to anyone in this space because it's way too boring for 99.9% of people. But excuse me. But if you did that and you were able to, on average, I mean, some years you might be down, and next year you might be up 200%, etc. Because we know that sentiment changes so much. So maybe, yeah, okay, let's say you double every 2 years, you have some kind of growth curve like this, whatever. It's like some years, yeah, you're down 40%, the next one you're up whatever. But the overall trend is like a doubling every 2 years. For if you did that for 15 years, deposited $200 every month, in 15 years you would have gone from $10,000 to 366 million. Whereas in reality it might be, since this is such a high risk high reward story, it might be that a few companies go to zero, some goes up 500%, some goes up 200%, some goes up 700%, etc., etc. So I mean, let's say in 2 years, 50% of your companies went down 50. Well, I haven't done the calculations, but like, yeah, 50% of your companies went down 50%. 25 went up to 400%. 25 went up 300%. Maybe that's a double or something. Still, 50% of your holdings got cut in half, but but some actually did well in multi-bag. And let's say that evens out to a 100% return over 2 years. In the long run, that will have huge implications. You will make a lot of money, even with 50% of your stories not working out, let's say. I hope I got most points across that I plan on doing. So I mean, it's like, Warren Buffett says, rule number 1, don't lose money. Rule number 2, see rule number 1, etc., etc. That's very hard to do in this sector because it's so high risk, but you can diversify enough that the odds of you having too many permanent losses goes down. Yeah. These are all very important concepts. Compounding, probably if you start to get how rich you can become if you only average 20% per year, it's quite mind-boggling. It's like I have no idea. I mean, as soon as you get how much this sector can go up and down, and this is where you want to belong, and this is when you want to take money off the table. I mean, if you only caught let's say you only buy when this sector hits this purple line, and you sell as soon as it goes up there. So that's like 200%. Here we hit it again. It was actually a bloodbath back there, but it's like, okay, maybe, yeah, okay, let's say you only play this portion on the long side, and obviously you just buy more the lower it is and sell more the higher it goes, etc. I mean, you could just take, like I was gonna say, the now and then get in, make the easy money. This sector is very hard up here because it's very hard to find something cheap. Down here everything is cheap, even the best ones. Thanks for listening. If I talked about any juniors, assume I own them, assume everyone is a sponsor, so assume I am biased. Do your own due diligence. Don't invest money you cannot afford to lose. Again, this is a marathon. If you blow up your entire portfolio from taking too much of a risk, that's never going to compound. I mean, think about it. It's like, yeah, okay, a permanent loss of let's say you eventually figured out how to double your money every 2 years. So let's say you took a 2%, $2,000 permanent loss. In 15 years, if you don't have that money, you missed out on 1 point. Well, I shouldn't have deposits in here. That 2,000 money could have been worth $385,000. It's very expensive with permanent losses. But permanent losses are not, are real losses. If something goes down, if something that is worth this much, you buy that here when you have expected, you think that, hey, one of these days, sometime in the future, I'm going to make 95%. If that goes down 33% and nothing bad has happened to the case, so the value is intact, that's a 32.8% paper loss. That's not a real loss. That's not a permanent loss. Because if the value is here, someday it's going to go back up there. If you buy more, you'll make even more money. Yeah, thanks for listening. Bye bye.